Hi, all. Welcome back to my YouTube channel. I hope you all are doing fantastic and studying well for your FRM exams. So, topic that we have today is arbitrage. Mainly, if I were to name correctly, it's law of one price from paper 4 valuation and risk models, FRM level 1. So, we will study this using one example on bonds. So, many concepts like bond, zero coupon, coupon bearing bonds, arbitrage will that this question will test your understanding on all these concepts. So let's have a look. So we have been given three bonds, and so just for our understanding, let's name these bonds as ABC. So bond A is zero coupon bond, which has YTM of 4%, and bond B is also zero coupon bond, so which has a YTM of 8%, and bond C is a coupon bearing bond which has an annual coupon of 8% and power. So YTM and coupon are same. That's why your bond is trading at par. So current prices of bonds ABC are given. So what happens? We have been given that 2 year spot rate in the market is this. So this is a portfolio, okay? And now we have been told that 2 year spot rate is 8.167% instead of 8%. So is there an arbitrage opportunity? If so, describe the trades necessary to exploit the arbitrage opportunity. So basically, if I were to tell you what is arbitrage, it's like if same thing is getting traded at two different prices in two different markets, trader exploit that arbitrage opportunity. So in this case, it's a portfolio and this is a market. We see that this is something which bank might be selling or buying, and this is where we see market, and we are observer, we are noticing that is selling this portfolio, and at market this is a spot rate. So we have been asked if we can exploit the arbitrage opportunity. So method to deal with this kind of question, you can just say it's a three steps. You can check if arbitrage opportunity exists. So this is a number one step. Important to know it if at all it exists. If it doesn't exist, rest of the steps will not apply. So first one is if it is exist, yes or no. If yes, if exist, which one will you buy and which one will you sell? And so firstly, decide if it exists. Second one, what to buy, what to sell. And third one is how much to buy and how much to sell to get riskless profit today. So you just build a structure in such a way that you take a benefit of riskless profit today. So let's see how we do it. So now we have been told that 2 year spot rate has gone up to 8 point, or it's in market it's 8.167%. So first important point to note is because the bond A is just 1 year bond, because of this spot rate, it will not be impacted. So bond A has no impact because of this. But yeah, maybe we can use this also to bridge any deficit that we may have in cash flows. So, but yeah, from this perspective, it will not impact 1 year bond. So let's have a look what impact it has on 2 year bond. So initially your YTM was 8%. Now it is spot rate is so for zero coupon bond, YTM and spot rates are same. So let's see that what is the price of bond B with new spot rate. So what I'll do, I'll just calculate. So par value is 100, and with I'll just see that what is the price at one point discounting rate of 1.7% for 2 years. Okay. So let's calculate this. So it's coming to be 85.46936. 46936. So important point to notice, your portfolio bond is at, so let me write this as a price of bond B in portfolio, and this is in market. These are just for our notation and understanding. So in your portfolio, it is priced at 85.734, and in market it is priced at 85.46, 85.46. Just if we compare, this one is expensive. Bond B in portfolio is expensive. And a simple rule to decide what to be done for expensive, you sell expensive. So it's a common sense, I would say. I mean, you sell whichever is expensive and you buy whichever is cheap. So we got one bond portfolio B is expensive, so we will sell this. Now let's see that how it has impacted a 2-year zero coupon or 2-year coupon bearing bond. So if I were to calculate price of bond C, currently because in portfolio YTM and coupon are same, it's at 100. But if I try to calculate what's the price if I use this 2-year spot rate as this, but very important point to notice that the coupon that you have 8, it would be discounted at 4% because 1-year spot rate has not changed. So the first coupon would be discounted at same rate, that is 4%. Yeah, it will impact your bullet payment, which is at second year. So 108, it would be discounted at new spot rate, this one, 8.167%. So if I calculate this quickly, it comes around 99.9. So just because it has an impact on the second year maturity, so it will just impact on the new the second year cash flow. Yeah, it's 99.9. It's coming as 99.9. Just give me a moment. Let me verify. Yeah. So for this one, just one correction because it's for bond A. Over here, it would be 8%. So your price would come around 99.71. So if you notice, this was 100 because this 2-year spot rate went up from 8% to 8.167%. So your new price would is little lower. So bond C is cheaper. So what you do, you buy this thing. So this is cheaper, you will buy. So eventually you can decide from this also because this is slight gray area. For, I mean, 2-year spot rate, we have information, but we don't have information about new YTM for 1 year. So for simplicity, we have taken it as a 8%. Yeah, but the key thing is you can on bond A, no impact. So if I were to summarize, bond A No impact from change in 2-year spot rate. Bond B is expensive with this change, and bond C is cheap. So what we'll do, firstly, opportunity exists. Yes. Now what to buy, what to sell, because B is expensive, we will sell bond B. Bond B would be sold, and bond C will be bought. So this is the conclusion so far. Now, very important, if you, this is something which is very key information, key thing, key step, I would say, how much to buy, how much to sell to get riskless profit today. Very important. Let's see how we do it. So let's, first of all, I'll just fill this information so that now, initially the question one was if arbitrage exists. Yes, we saw that it exists. And now we have decided that bond B is to be sold and bond C is to be bought. Okay. And I'm just for understanding, I'm writing the cash flows because it's a zero coupon bond. Uh, there is, I mean, you just buy on a first year, you get 104, or you can just say because it was a discounted bond, 96.154, it becomes 100 at year one. And for second bond, it's also zero coupon. So there are no coupons intermediary. So on first year, you don't get anything. On second year, you get 100. So on first year, the bond A is bought at, I would say, minus 96.154. On second year, it gives 100, which appreciate at a rate of 4 year. And similarly, bond B is bought at 85.734. I'm just writing minus. So just imagine that you are buying it and it becomes 100 at year two. And third bond is like you you buy a bond, we'll see at what price. And the first year it gives you 8% coupon, $8 coupon. And on year second, it becomes 108. So this is just something which already given and we have explored it, but just I'm filling the tables, what we did over here. So yeah, initially if I were to calculate what's the bond price at, yeah, it would be 100 because your coupon and this thing are same. So you buy it at a minus 100, it gives you $8 coupon at first year and 108 principal plus coupon on second year. Now, the second question, I mean, we saw that there is a arbitrage opportunity because of this. This table I just filled for whatever was given initially. Just, I mean, no relevance with how much to buy, how much to sell. This is a table where we'll explore how much to buy, how much to sell. Okay, yeah. So, see, for example, if I sell this bond, okay, so what will happen if I sell this bond today? I will receive something, okay, and what I'll receive, we'll see, and I need to buy this bond, okay. If I need to buy this bond, I would need some cash. So say minus 100 I would need because I need to buy this bond, okay. If I buy this bond, it would give me $8 coupon. If I mean I'm a long bond holder, I have invested $100. I'm getting $8 at first year coupon, and I've received my 108 on the second year. Now, very important, I need to bridge these blocks in such a way that on year one, the net outflow is zero on net, and on second year also it's net outflow is zero, and I earn something today by creating by buying or selling something. So if I go above, this is a uh, so this is a 2-year zero coupon bond. Okay, so it will not have any coupon in between. So this is, I would put hash because there is nothing. So it is a zero coupon, 2 year zero coupon bond. On a 1 year, it will not gain or receive anything. Directly on maturity, it is going to get what it will get. We'll see what it will get. But for now, my objective is to offset this +8 with -8. Given on first year, there is nothing. I need -8 over here. Okay, because I need to ensure that eventually on first year and second year, my cash flows are zero. How do I do that? I need to buy or sell something. We have bought this one -100. You can start from some other point also. You can just sell this one. But yeah, that's because it's 100, it would be very easy to tackle this information. So it's -100. Now, if I want to, uh, if I have to give -8 to someone at first year, I need to invest something today. Okay, and that would in this bond, in bond A, it would. So initially, I mean, to decide what I will do with, because initially, if you recollect, there was no impact on bond A with the increase in spot second year spot rate. So we were clueless what to buy. I mean, if it is a cheap or expensive. But given now need has arrived, I need to give some -$8 to someone. So I need to short this bond at a first year. So this also we will short on bond. I mean, I would be giving. So it's short at first year, first year -$8. To do this, I need to invest something today. So I mean, if I short something, I get something today, which I'll invest at a 4%, and this will eventually become 8. So 8%, $8 or -8. I mean, I mean, because it's something I have to pay to someone. So today it would be plus. I mean, eventually you can say you have sold something in future. So you have received something today, and what you will receive, $8 discounted at 4%, it would be equal to, around 7.69. So what you will do, you will punch in 7.69 here. So by selling this 1 year zero coupon bond, you have sold quantity in such a way that you receive $7.69 today, which eventually becomes $8, which will offset this $8 in at first year. Now, only thing remains is this one. To How do we tackle with $108 over here? So what we'll do? So this is a 1 year coupon, zero coupon bond. So it will not have anything at the second year. Now what I need to do, I need to uh, I need to, I mean, I want to sell 108 at a second year. So if I sell this bond in second year to get 108, so I need to get similar quantity. So, and 108 in a similar way, how we discounted 8 at 4%, this 108 would be discounted at 8%. So let's discount 108 at 8%. So, and very important to note, it would be power to the 2. Let me just calculate quickly for you. It's around 92.59259. 92.59. Let me just, I mean, there are numbers, so let's just round it off. So if you sell this bond in second year, you receive something, and what is that you receive is 92.59. So you buy this bond, the coupon bearing bond at 100 because it was a cheap, and you sell this second bond, and eventually we used this first bond A to bridge our gaps to make our cash flow zero in future. So let's see what's the arbitrage profit out of this. So minus 100 plus 7.69 plus 92.59. So it gives you around 0.28%, 0.28. So it is on $100 investment. What you invest is what $100, and that too also you took by selling something. So without doing anything, it's of course theoretical. In practice, it takes time. But if trader observes this kind of profit, so it's just on $100. So they have millions in their pocket to invest and draw up, take advantage of arbitrage opportunity. Hope this like. Of course, the question is a bit tricky. Book may not give you the complete sense out of it. This is a very layman explanation that you can follow to back your understanding. Yeah, follow our YouTube channel and stay connected. Prepare well for the exam. All the very best. Thank you.